For a century, the rules of investing were simple. When stocks crash, you buy gold. When the world gets messy, you hide in US Treasuries. But in February 2026, those rules didn't just break, they evaporated. We are currently witnessing a historic safe haven crisis. Wherefore, the first time in modern history, gold, bonds, and the US dollar are all falling at the same time. The 60/40th portfolio is dead, and the traditional safety nets are being shredded by a combination of the Warsh pivot, massive sovereign debt, and a global trust deficit. Today, we re-looking at the triple red event of 2026 and where the smart money is moving now that the safe havens have turned into storm zones. For generations, investors relied on a simple playbook. Economic storm clouds on the horizon. You'd run to the safety of government bonds, worried about inflation debasing your currency. You'd stack up gold bars. This diversification was the bedrock of modern portfolio theory, the very foundation of the classic 60/40th stock and bond split. It was a strategy built on the idea that these assets moved in opposite directions, creating a natural hedge. When one went down, the other went up, smoothing out the ride and protecting your wealth. But the events of early 2026 have shattered that paradigm. This isn't just another market downturn. It's a fundamental rewiring of financial reality. The crisis we're facing today is one where all the fire exits are blocked. The very assets designed to protect you are now sources of risk themselves. This is the death of the safety net, and understanding why it happened is the key to surviving what comes next. The first pillar to fall was gold. After an incredible run to $5,000 an ounce in late 2025, the yellow metal hit a brick wall on January 31, 2026. The trigger, the nomination of Kevin Warsh as the new Federal Reserve Chair. Warsh's hard money reputation and his vocal plan to aggressively shrink the Fed's massive balance sheet sent a shockwave through the markets. Suddenly, the narrative that had propelled gold to record highs was thrown into reverse. For years, the logic was simple. The Fed prints trillions of dollars, creating inflation, and gold, as a finite asset, becomes the ultimate inflation hedge. But Warsh signaled a new era. His nomination wasn't just a change in leadership, it was a philosophical U-turn for the world's most powerful central bank. The market immediately priced in a future where the Fed would stop being the buyer of last resort for government debt. This prospect of quantitative tightening, or QT on steroids, caused a massive liquidation in the gold market. Investors who had piled in, betting on perpetual money printing, scrambled for the exits. In just 1 week, gold dropped a staggering 9%, and silver, its more volatile cousin, slumped by 15%. This wasn't just a healthy correction. It was a violent repricing based on a new reality. The realization dawned that if the Fed truly stops printing money to monetize government debt, the most immediate and powerful fuel for the inflation hedge argument for gold disappears. The very policy that made gold a star performer was being unwound. For the countless investors who treated gold as an insurance policy against monetary madness, the premium on that policy suddenly became far too expensive to hold. The so-called unbreakable safe haven had just shown its first crack. Next, let's look at the bond market, the asset class once called the bedrock of risk-free returns. Usually, when investors are scared, they instinctively flock to the perceived safety of 10-year US Treasuries. It's been the ultimate flight to quality trade for decades. But in 2026, something is fundamentally broken. The United States national debt has spiraled to such extreme levels, now approaching a staggering 125% debt-to-GDP ratio that bonds are no longer seen as risk-free. They are now seen as risk-full. The final straw was the passage of the One Big Beautiful Bill Act, a massive spending package that added trillions more to an already unsustainable deficit. This move spooked the very buyers the U.S. relies on to finance its debt. Foreign creditors, particularly nations like China and Japan, have been aggressively slashing their holdings of U.S. Treasuries. Their share of the market has plummeted to just 30%, a historic low. They are no longer willing to fund America's spending habits with their savings, especially when the return is so poor and the risk of default, whether through inflation or outright, is no longer zero. As a result, we are seeing a terrifying phenomenon in the bond market known as a bear steepening of the yield curve. This is where long-term interest rates are rising sharply even as the economy slows down. It's the bond market's version of a vote of no confidence. It signals that investors are demanding a higher return to compensate for the growing risk of holding U.S. debt for the long term. In the safe haven crisis of 2026, holding a 30-year U.S. Treasury bond is no longer a safe investment. It's a speculative bet that the U.S. government won to be forced to inflate its way out of its colossal debt pile. And right now, that is a bet that fewer and fewer people are willing to take. The bond market's widowmaker trade is back, and this time, it's claiming the entire safe haven thesis as its victim. So, if gold has proven to be volatile and bonds are now considered risky, where is all the money going? The answer is that there's no single destination. Instead, we are witnessing a fragmented flight to quality. where investors are scrambling to find any port in this unprecedented storm. The old, simple answers are gone, replaced by a complex and rapidly shifting landscape of new, unproven alternatives. Some of the most sophisticated capital is moving into agentic AI funds. These are advanced quantitative funds that use artificial intelligence to trade at millisecond speeds. They aren't betting on long-term trends. They're designed to catch tiny microtrends and liquidity mismatches in the market chaos, scalping small profits hundreds or thousands of times a day. It's a high-tech solution for a high-tech crisis. Others are going back to basics, looking for a fiat currency that still has integrity. The Swiss franc has reclaimed its historic status as the world's premier fiat safe haven. Why? Because Switzerland has maintained fiscal discipline, with a low debt-to-GDP ratio of just 37%. The Swiss government isn't in the same desperate situation as the US, Europe, or Japan. Its currency is backed by a responsible balance sheet, making it a rare beacon of stability. And then, of course, there's the digital gold debate. While Bitcoin has certainly been volatile during this crisis, it has shown surprising resilience. It has held the $90,000 line far better than silver held its key support levels. For example, for a growing number of investors, its decentralized, non-saver nature makes it a more compelling hedge in a world where trust in governments and central banks is collapsing. But the biggest trend of all, a massive flight to absolute liquidity. The safe haven of 2026 isn't a specific asset anymore, it's cash and short-term T-bills. Investors are choosing to hold US dollars and very short-term government debt, not as an investment but as a way to stay out of the fire, waiting on the sidelines for the 2026 roller coaster to finally find a floor. The safe haven crisis of 2026 is a brutal wake-up call for every single investor. The era of passive safety, where you could just buy a simple mix of stocks and bonds and forget about it, is over. We have entered a new and much more dangerous world, in an environment where the very nature of the Federal Reserve is being redefined and global debt has reached a breaking point. The old rules simply no longer apply. Your only real safety now is active management and intelligent diversification, not just across asset classes, but across jurisdictions and currencies as well. The 2026 crash proved a vital lesson. Even an asset as timeless as gold can have a very, very bad day. If the policy shift from the powers that be is strong enough and fast enough, nothing is invulnerable when the fundamentals are this broken. As we move deeper into what historians will likely call the Warsh era, the most important question for your portfolio is no longer what is safe. It has become what is liquid. When the storm hits, the ability to move quickly, to get to cash, is the ultimate form of safety. Everything else is just a bet on a system that is showing cracks everywhere. I'm curious to hear your strategy. Let me know in the comments. Are you still holding gold at $4,800? Convinced of its long-term value, or have you moved into the cash and carry trade, waiting for the dust to settle? Thanks for watching. Don't forget to subscribe as we continue to track the next big shift in our 2026 Global Risk Report. Stay safe out there.